Well, good morning. It's actually Thursday morning, October 25th. I'm headed down to Wilmington this morning. It's about 7:40. I'm on Interstate 40 heading down to Wilmington to see a few clients. But do a lot of thinking as I'm driving down the road, and sometimes it's some of my best thinking. And this morning, just thinking about the market, and of course the last couple of weeks the market's been down considerably, and especially yesterday, Wednesday, market's down again, triple digits, and in fact we started to see what we call panic selling, capitulation yesterday afternoon. Looks like some panic selling going on. So I wanted to take this time to make sure that my clients, my investors, that we are doing smart things. And the first thing that I can tell you, the first advice I can tell you is that we're going to remain calm. You have to remain calm during these times. And I think the first thing to do to help you remain calm is please turn off financial entertainment shows. Anything MSNBC or CNBC and Bloomberg Financial, turn those off right now. It'd be very helpful, because I've said before, TV sells on panic and fear. Unfortunately, we respond as a human race to panic and fear. And the coverage on TV is a lot more widespread when we have weeks and downturns like we've had lately than if we compare it to when the market is doing well. So number one is to remain calm. Now, to get into the data a little bit, much of what's happening lately, it doesn't even make sense. For example, we've got companies reporting this week terrific earnings reports from a lot of large companies, yet they're falling the same amount as companies with reports that maybe are not so stellar. So that's number one. Makes no sense. I would bet that we're going to have a big rally on the market before the end of the year. And we certainly don't want to miss out on that. We do not see at this point that we're going into a recession. Now, there have been some reports, for example, housing was down slightly last month, so we're going to keep a watch on that. But panic selling right now and getting out can hurt you more than anything. That's why the average investor, and I show this in a class I teach at the universities, the average investor, their return is 3% average. That's what they return, 3%. It's terrible. Why is that? Because they do, quite frankly, dumb things. They sell when they shouldn't. They buy in on the high side. They don't stick to their plan. And then they get crushed for it. Another thing to remember, when you have the type of volatility that we have right now, you're going to have volatility on the upside too. Historically, when we have big down days, there's going to be some big up days close to that. And it can hurt your return considerably if you're not around for that, if you're not participating in that. So we have to be careful around that. Another point I'll make, They say the market is down 5%. The market's down 10%. Well, number one, nobody's invested in the market because that's impossible. You can't invest in the market. Now, there's index funds out here that mimic the market, but it's not an exact science. But more so than that, what my point is, if you are a conservative or moderate investor with us, then you're going to have some fixed income, meaning that some of it is going to be in bonds or alternatives or dividend stocks, things that don't maybe respond on the downside or go down as much. So if you're 50% in fixed income, 50% equities, and the market's down 10, you're probably only down 5 or 6. So don't buy into I'm down the same amount, because you're probably not. Now, if you've got some aggressive accounts with us, you might still be moderate, but you might have a couple of aggressive accounts. Sure, those might be down as much or more than the overall market, because we are willing to take on that extra risk to get those returns. Like some of our most aggressive model last year returned 34%. And if you're going to do that, you've got to be willing to stomach the downturns as well, because you're happy when we get those 34% returns for sure. So you've got to be willing to take on that extra risk and be okay with that. So that's another point that I'll make. Finally, the market has had over 125 corrections over the last 100 years plus. They're going to happen. You have to know that they're going to happen and plan for it. So there's no panic. We think right now this is mostly emotional. The economy is still growing at a pace better than it has in years. So maybe the market's just taking a breather. But now I do think it maybe is having a little temper tantrum around the Fed raising rates. Maybe they are being a little too aggressive. Time will tell. And secondly, of course, China's market and global markets have been hit hard, and especially China around, and yes, it's probably around the trade war. But eventually we'll work through that. So I really feel like that we're going to have a rally before the end of the year. It might be right after the elections. That's another thing that's going on now that's causing volatility, is this election coming up in 2 weeks. I will be glad when it's over. Historically also, remember, November and December are historically the best months to be invested. So let's don't miss out on that. Now, at the end of the day, we do have to make sure that your risk tolerance is aligned so that when we do have downturns, they're expected and you're not overly aggressive. That's why we have you fill out risk profile statements. Now, sometimes people may fudge on that a little bit, and when the market's going up, they want to be a part of it, but then they don't want to be part of the downturn. So if you feel like, hey, I am being overly aggressive and we need to adjust those weightings, certainly we need to get together and discuss that. Otherwise, let's not panic sell like all these other people. Many, and I would say that a lot of it is the do-it-yourself investors that, quite frankly, maybe they don't know what they're doing, and and that turns into panic selling. So anyway, that's on my mind this morning. Let's be smart. By all means, if we start going into what we think is going to be a severe recession, of course, then we might want to make a few adjustments. But we're not there yet. We're not at that point. We've seen this volatility before, and I just want to make sure that our clients do the right things. So anyway, if you have questions, call our office. We can talk through it. But what I'm suggesting right now is that we're going to sit tight. We're not going to worry. I would expect a rally before the end of the year. Also, there's stock buybacks, a lot of stock buybacks coming up. That's going to probably help the market as well. So have a great weekend. Turn off the television if they're talking about the investments and fear-mongering and all that. Don't listen to it. Call us if you are fearful, and we can talk through it. I hope you all are doing well. And again, have a good end to the week and weekend.